Picture this. Every American believes their home is their greatest investment, their ticket to wealth, their safe harbor in financial storms. But what if I told you that right now, while you're watching this, the very foundation of that belief is crumbling beneath your feet? The median US home price has soared 47% since 2020. Mortgage rates have tripled. Construction costs have exploded by 35%. Yet somehow, everyone still believes this rocket ship will keep climbing forever. Here's the unsettling truth. Every housing bubble in history looked exactly like this just before it burst. The scaffolding is buckling, the warning signs are flashing red, and most people are too busy celebrating paper gains to notice the trap door opening beneath them. The question isn't whether the housing market will crash. The question is whether you'll see it coming. This is Market Shadows, where we expose the hidden mechanisms behind financial illusions. And nothing is ever as simple as it looks. The American housing market isn't just expensive, it's systematically broken. What looks like prosperity is actually a carefully engineered bubble, inflated by forces most people never see coming. If you trace the threads of this story back to their origins, you discover a pattern that has repeated throughout history, each time destroying the wealth of those who trusted the system most. This isn't about doom and gloom. This is about understanding the invisible architecture that's been built around you, recognizing when that architecture becomes unstable, and positioning yourself to survive what comes next. The housing market of 2025 isn't an anomaly. It's the predictable result of decisions made decades ago coming home to roost. To understand how we got here and where we're headed, we need to go back to the beginning. We need to examine how artificial scarcity is created, how money flows through the system, and why crashes aren't accidents. They're features, not bugs. The story begins with a simple question that nobody wants to answer. What happens when everyone believes the same lie at the same time? In 1938, something radical happened that changed American housing forever. The Federal Housing Administration didn't just create mortgage insurance, it created the blueprint for turning homes into financial weapons. But the real revolution came in 1970, when a government-sponsored enterprise called Fannie Mae began packaging mortgages into securities and selling them to investors worldwide. This was the moment housing stopped being about shelter and became about speculation. Before 1970, when you got a mortgage, your local bank held that loan until you paid it off. The banker knew you, knew your neighborhood, knew whether the house was actually worth what you were borrowing. Risk stayed local. Consequences stayed local. Sanity stayed local. But Fannie Mae's innovation was brilliant and terrifying. They discovered they could slice up thousands of mortgages, bundle them together, and sell shares to pension funds, insurance companies, and foreign governments. Suddenly, a mortgage on a house in Phoenix could be owned by a pension fund in Norway. The banker who approved your loan, he sold it to Fannie Mae before the ink was dry. Here's where the incentives went sideways. When banks kept mortgages on their books, they cared about one thing: will this person pay back the loan? But when banks could sell mortgages immediately to Fannie Mae, they started caring about something else entirely. How many mortgages can we originate this month? This shift created what economists call a moral hazard, a fancy term for profit without consequences. Banks could make increasingly risky loans because they weren't holding the risk. Fannie Mae could buy increasingly risky mortgages because they had an implicit government guarantee. And investors could buy increasingly risky mortgage securities because they believed the government would never let housing fail. Everyone was right, until they weren't. The first crack appeared in the 1980 savings and loan crisis, when over 1,000 banks failed after making speculative real estate loans. But instead of learning from this disaster, the system doubled down. In 1999, the Glass-Steagall Act, which had separated commercial banking from investment banking since the Great Depression, was repealed. Suddenly, the same institutions that took your deposits could gamble with derivatives based on your neighbor's mortgage. The stage was set for 2008. But here's what most people don't understand about 2008. It wasn't a failure of the system. It was the system working exactly as designed. The housing bubble wasn't an accident. It was an inevitable result of turning homes into poker chips in a global casino. When the crash came, who got bailed out? Not the homeowners who lost their houses, not the communities that were destroyed. The banks that created the mess got $700 billion in taxpayer money, while 10 million families lost their homes to foreclosure. But here's the truly chilling part. After 2008, instead of fixing the underlying problem, we made it worse. The Federal Reserve dropped interest rates to zero and started buying mortgage-backed securities directly, essentially printing money to inflate housing prices. Quantitative easing pumped $4 trillion into financial markets, and much of that money flowed straight into real estate. The result? Housing prices recovered and then soared past their 2008 peaks. The same toxic financial instruments that caused the crash were repackaged and sold again. The same banks that nearly collapsed the global economy became even larger and more systemically dangerous. And now we're here in 2025, staring at a housing market that makes 2008 look quaint. The median US home now costs $420,000, a figure that would have been unthinkable just 5 years ago. In cities like San Francisco, Austin, and Boise, the average home price has more than doubled since 2020. Young families need household incomes of $200,000 or more just to qualify for a basic mortgage in many markets. But here's the mechanism that nobody talks about. This isn't just inflation. This is the systematic financialization of human shelter. When BlackRock and other institutional investors started buying single-family homes by the thousands, converting them to rentals, they weren't just participating in the market, they were changing its fundamental nature. Homes are no longer primarily bought by families to live in. They're bought by algorithms to generate yield for pension funds and sovereign wealth funds. When housing becomes an asset class for global capital, local wages become irrelevant. A teacher in Phoenix isn't competing against other teachers for housing. She's competing against Norwegian pension funds and Chinese billionaires. This is the architecture that was built around us while we were sleeping. A system where homes are designed to be unaffordable to the people who live and work in the communities where they're built. A system where artificial scarcity is maintained through zoning laws, building permits, and environmental regulations that take years to navigate. And now the scaffolding is beginning to buckle. The question that should keep you awake at night is this: what happens when a market built on infinite growth runs into finite resources? What happens when the generation that was supposed to buy homes from aging baby boomers can't afford them? What happens when the artificial demand created by cheap money and institutional investors suddenly disappears? We're about to find out. Here's how the machine works and why it's about to break down. Since 2020, the Federal Reserve has been running the most aggressive monetary expansion in American history. They dropped interest rates to zero, bought $120 billion in bonds every month, and signaled to markets that money would stay cheap indefinitely. This wasn't monetary policy. This was financial engineering on a scale never before attempted. When mortgage rates fell to 2.5%, something extraordinary happened. Suddenly, buyers could afford to borrow almost twice as much money for the same monthly payment. A family that could afford a $1,800 mortgage payment could suddenly bid $400,000 instead of $250,000 for the same house. But here's the cruel mathematics of cheap money. When everyone can borrow more, nobody can afford more. All that additional borrowing power just gets capitalized into higher prices. The sellers capture the benefit, while buyers end up with the same monthly payment and much more debt. This is the fundamental mechanism behind every housing bubble: artificial demand created by artificial money. When the government makes it easier to borrow, it doesn't make housing more affordable. It makes housing more expensive. The data tells the story with brutal clarity. From 2020 to 2024, the median home price rose 47%, while median household income rose just 12%. The average American now needs to spend 35% of their income on housing, compared to 25% in 2019. In cities like Los Angeles and Seattle, that figure approaches 50%. But the real mechanism runs deeper than mortgage rates. The entire economy has been restructured around asset price inflation. When the Fed creates money through quantitative easing, that money doesn't go to workers in the form of higher wages. It goes to asset holders in the form of higher prices for stocks, bonds, and real estate. This creates what economists call the Cantillon effect. Those closest to the money printer benefit first and most, while those furthest away get crushed by higher prices. Wall Street gets cheap money to buy assets. Main Street gets expensive assets and stagnant wages. The housing market became the primary transmission mechanism for this wealth transfer. Since 2020, homeowners have gained over $7 trillion in paper wealth through rising home values. But renters, disproportionately young, minority, and lower income, have seen their housing costs skyrocket while their purchasing power evaporated. This isn't sustainable, and the cracks are already showing. Construction has slowed to a crawl, as builders struggle with 35% higher material costs and labor shortages. Mortgage applications have fallen 45% from their peak as higher rates price out buyers. Inventory is starting to build in previously hot markets like Austin, Boise, and Phoenix. But here's where the mechanism gets dangerous. The entire financial system is now dependent on rising home prices. Banks hold $12 trillion in mortgages and home equity loans on their books. Pension funds and insurance companies own trillions more in mortgage-backed securities. State and local governments depend on property taxes that assume ever-rising home values. When asset prices are rising, this creates a virtuous cycle. Higher home values make homeowners feel richer, so they spend more money. Banks see their mortgage portfolios appreciate, so they lend more freely. Governments collect higher property taxes, so they spend more on services and infrastructure. But when asset prices start falling, every gear in this machine runs in reverse. Homeowners feel poorer and cut spending. Banks see their mortgage portfolios declining and tighten lending standards. Governments face budget shortfalls and cut services. Construction workers lose jobs. Real estate agents lose commissions. Mortgage brokers lose deals. This is exactly what happened in 2008. But the current bubble is larger, more widespread, and more systemically dangerous than anything we've seen before. The mechanism that created this bubble is now reversing. The Federal Reserve has raised interest rates from 0% to over 5% in less than 2 years, the fastest tightening cycle since the 1980s. Mortgage rates have more than doubled from their lows, pricing millions of potential buyers out of the market entirely. Meanwhile, the institutional investors who helped drive up prices are pulling back. BlackRock has slowed its home buying program. Foreign investors are retreating as the dollar strengthens and their home currencies weaken. The easy money that inflated this bubble is disappearing. But here's the twist that nobody saw coming. Inflation has made it impossible for the Fed to cut rates back to zero when the housing market starts crashing. Unlike in 2008, when deflation gave the Fed unlimited room to ease monetary policy, today's inflation means they're trapped. They can't rescue the housing market without reigniting the inflation that's already destroying middle-class living standards. This is the mechanism that ensures the coming crash will be different and potentially worse than 2008. The Fed's primary tool for fighting financial crises has been rendered useless by the very inflation their policies created. The mathematics are unforgiving. At today's prices and mortgage rates, the median American household would need to spend 45% of their income to buy the median American home. That's not a housing market. That's a system designed to exclude the majority of Americans from home ownership. Something has to give. Either wages rise 50% in the next 2 years, or home prices fall 30%. Since wages are sticky and asset prices are volatile, you can guess which adjustment is more likely. The machine that created this bubble is starting to eat itself. And when it does, the carnage will be spectacular. Here's the secret nobody wants you to know. The housing shortage isn't natural. It's manufactured. For decades, we've been told that high housing costs are simply the result of supply and demand. Too many people chasing too few houses. But that explanation misses the most important part of the story. The scarcity that drives up prices isn't accidental. It's carefully engineered by a web of regulations, restrictions, and policies that ensure housing stays expensive. Let's start with the most obvious example: zoning laws. In most American cities, 75% or more of residential land is zoned exclusively for single-family homes. This means that in the middle of a housing crisis, it's literally illegal to build apartments, condominiums, or even duplexes in most neighborhoods. These laws weren't created to protect homeowners. They were created to protect home values. When you can't build more housing in desirable areas, existing housing becomes more valuable. When supply is artificially constrained, prices artificially inflate. But the mechanism goes much deeper than zoning. The entire regulatory apparatus around housing is designed to make new construction as expensive, time-consuming, and risky as possible. In San Francisco, it takes an average of 4 years and $1.2 million in regulatory costs to get approval for a new apartment building. In Los Angeles, environmental review processes can add decades to construction timelines. In Seattle, parking requirements force developers to include expensive underground garages, even in neighborhoods with excellent public transit. These aren't bugs in the system, they're features. Every regulatory hurdle, every environmental review, every community input session is designed to give existing homeowners veto power over new construction. The result is a system where those who already own homes can prevent others from getting them. This creates what economists call regulatory capture, when the industries being regulated end up controlling the regulators. Homeowners vote in local elections at much higher rates than renters. Homeowners organize neighborhood associations and show up to city council meetings. Homeowners hire lawyers and lobbyists to protect their property values. The result is a political system where any policy that would make housing more affordable, like allowing more density, reducing parking requirements, or streamlining permitting, faces fierce opposition from the very people who benefit from high housing costs. But here's where the hidden truth gets really dark. This isn't just happening at the local level. Federal policy has been systematically designed to inflate housing costs for over 50 years. The mortgage interest deduction alone costs taxpayers $30 billion per year, money that flows directly to homeowners in the form of reduced taxes. But renters get nothing. This policy artificially increases demand for homeownership while providing zero benefit to those who can't afford to buy. Even more perverse is the capital gains exclusion for primary residences. Then there's the carried interest loophole that allows private equity firms to buy thousands of homes and pay lower tax rates on their profits than teachers and firefighters pay on their salaries. The government isn't just allowing financialization of housing, it's subsidizing it. Meanwhile, every program designed to help renters or first-time buyers gets attacked as government interference in free markets. The same politicians who support billions in subsidies for existing homeowners suddenly discover their free market principles when someone suggests helping renters. This is the architecture of artificial scarcity. Privatize the benefits of high housing costs while socializing the costs. Homeowners get tax breaks, equity gains, and political power. Everyone else gets displacement, debt, and despair. The numbers tell the story. Since 1980, the US has built fewer housing units per capita than any comparable developed nation. We're producing about half as much housing per person as we did in the 1970s, despite having better technology, more wealth, and higher demand. This isn't because we've run out of land. The US has more developable land than almost any nation on Earth. It's not because we lack construction workers. Immigration could solve that problem in a matter of years. It's not because we lack money. Americans spend more on housing than ever before. We're producing less housing because we've designed a system that rewards scarcity and punishes abundance. But here's where the mechanism becomes truly insidious. Artificial scarcity creates real scarcity. When regulations make it impossible to build affordable housing, developers focus on luxury units where the margins can cover regulatory costs. When zoning prevents density, families compete for the few single-family homes available. When permitting takes years, builders avoid risky projects and stick to safe suburban sprawl. The result is a housing market that serves capital instead of people. In Los Angeles, there are more vacant homes than homeless people, but zoning laws prevent converting those homes to affordable housing. In San Francisco, tech companies shuttle workers 50 miles each way because housing near jobs is illegal to build. This system hasn't just failed, it's succeeding exactly as designed. High housing costs transfer wealth from young renters to older homeowners. Expensive housing keeps poor people out of rich neighborhoods. Artificial scarcity ensures that those who own assets see those assets appreciate faster than wages or GDP growth. The tragedy is that this didn't have to happen. Countries like Germany, Austria, and Singapore have maintained affordable housing through different policy choices. They treat housing as infrastructure rather than investment, prioritize renters' rights over property values, and use public policy to ensure homes serve their primary purpose, giving people places to live. But in America, we made different choices. We chose to treat housing as a financial instrument. We chose to reward speculation over habitation. We chose artificial scarcity over abundance. Now we're living with the consequences. A generation locked out of homeownership. Families spending 50% of their income on rent. Teachers and firefighters commuting 2 hours each way because they can't afford to live in the communities they serve. And the cruelest irony? The same artificial scarcity that inflated this bubble will amplify the crash when it comes. When demand disappears, all those regulatory barriers that prevented new supply will prevent new construction from absorbing the shock. When prices start falling, the same political forces that protected homeowners on the way up will prevent the market from clearing on the way down. We've built a system designed to trap everyone inside it. Homeowners can't sell without losing their artificially low mortgage rates. Renters can't buy without taking on crushing debt. Builders can't build without navigating regulatory minefields. Cities can't reform without homeowner revolts. The hidden truth is that this crash was built into the system from the beginning. Artificial scarcity always creates artificial bubbles, and artificial bubbles always pop. History doesn't repeat, but it rhymes with devastating precision. In 1929, America was drunk on real estate speculation. Land prices in Florida had increased 1,000% in 5 years. Ordinary Americans were buying property with 10% down payments, convinced prices could only go up. Banks were lending money to anyone with a pulse. Sound familiar? The crash, when it came, was swift and brutal. Real estate prices fell 67% over the next 4 years. Banks failed by the thousands. The economy entered the Great Depression. But here's what most people don't know. The crash wasn't caused by the stock market collapse. It was caused by the real estate bubble that preceded it. Fast forward 96 years, and we're staring at an eerily similar pattern. But this time, the bubble is larger, more widespread, and more systemically dangerous than anything in American history. Let's examine the parallels, because they're impossible to ignore. Speculation fever. In 1929, ordinary Americans were flipping land in Florida, sight unseen, convinced they could get rich quick. In 2025, ordinary Americans are using HELOC loans to buy rental properties they've never visited, convinced they can get rich quick. The tools have changed, but the psychology is identical. Leverage explosion. In 1929, banks were making loans with 10% down payments and no income verification. In 2025, we have zero down VA loans, 3% down FHA loans, and stated income loans making a comeback. The leverage is actually higher today than it was in 1929. Institutional madness. In 1929, banks were packaging land deals into securities and selling them to retail investors. In 2025, we have mortgage rates, housing ETFs, and single-family rental securitizations that make 1929 look primitive. The financialization is orders of magnitude more complex. Geographic concentration. In 1929, the speculation was concentrated in Florida and California. In 2025, it spread across Phoenix, Austin, Boise, Nashville, and dozens of secondary cities that never experienced bubbles before. The contagion is national. Warning signs ignored. In 1929, voices warning about unsustainable prices were dismissed as pessimists and doommongers. In 2025, anyone questioning whether teachers should need $200,000 household incomes to buy starter homes is labeled a housing bear and ignored. But the most chilling parallel is this. In both 1929 and 2025, the financial system became completely dependent on rising asset prices to function. In 1929, banks had made so many real estate loans that falling property values would make them insolvent. In 2025, the entire banking system holds $12 trillion in real estate loans, more than the GDP of China. When home prices fall, bank balance sheets will crater. In 1929, local governments had become addicted to property tax revenue from inflated land values. In 2025, cities and counties across America depend on property taxes that assume home values will rise forever. When prices fall, municipal budgets will collapse. In 1929, ordinary Americans had leveraged their life savings into real estate, believing it was the path to wealth. In 2025, the average American family has 68% of their net worth tied up in their home. When prices fall, household wealth will evaporate. The mathematics are remarkably similar. In 1929, the median home cost about 3 times the median income. By the peak of the bubble, that ratio had risen to nearly 6 times income. Today, we've gone from 3 times income in 2012 to over 7 times income in 2024. The price appreciation is almost identical too. From 1920 to 1929, real estate prices rose approximately 50%. From 2020 to 2024, they've risen 47%. The timelines even match. Both bubbles took roughly a decade to inflate to unsustainable levels. But here's where 2025 becomes more dangerous than 1929. The Federal Reserve's response options are severely constrained. In 1929, when the bubble popped, deflation gave the Federal Reserve unlimited room to cut interest rates and print money. They didn't use those tools effectively at the time, a mistake that prolonged the depression, but the tools were available. In 2025, inflation has eliminated that option. Consumer prices are still rising faster than wages in most categories. Energy costs remain elevated. Labor markets are still tight in many sectors. If the Fed tries to rescue the housing market with zero rates and quantitative easing, they risk reigniting the inflation that's already destroying middle-class living standards. This creates an impossible choice: save the housing market and destroy the currency, or control inflation and let the housing market crash. There's no middle ground when asset prices are this disconnected from fundamentals. Meanwhile, the debt levels that finance this bubble dwarf anything from 1929. Total mortgage debt has reached $13 trillion, larger than the entire US. Economy was in 2000. Household debt-to-income ratios are at record highs. Corporate debt has exploded as companies borrowed cheap money to buy back stock and pay dividends. When the deleveraging begins, it will make 1929 look like a minor correction. But perhaps the most ominous parallel is political. In 1929, Americans believed they had discovered a new paradigm of permanent prosperity. Technology had eliminated the business cycle. Real estate would always go up because land was finite and population was growing. Sound money and fiscal discipline were relics of a bygone era. In 2025, we hear identical arguments. Technology has eliminated scarcity. Housing will always go up because land is finite and population is growing. Sound money and fiscal discipline are relics that prevent us from achieving our true potential. The hubris is identical. The delusion is identical. The rationalization is identical. And the outcome will be identical too. History shows us that bubbles don't deflate gradually. They collapse suddenly. When confidence breaks, leveraged speculation becomes forced selling. When forced selling begins, prices gap down faster than anyone thought possible. In 1929, it took just 6 weeks for real estate markets to lose 30% of their value. The collapse was so swift that many investors were wiped out before they could react. Margin calls forced sales that created more margin calls. Panic selling created more panic selling. The same dynamic is already building in 2025. Homeowners who bought at the peak are trapped by mortgage rates that make selling impossible. Investors who leveraged up on rental properties are facing cash flow problems as rents fail to keep up with carrying costs. Builders who borrowed to finance new developments are watching demand evaporate. All it takes is one major shock: a geopolitical crisis, a banking failure, an unemployment spike, to shatter confidence and trigger the cascade. And unlike 1929, when only wealthy Americans owned significant assets, today's bubble involves the entire middle class. When it pops, it won't just destroy speculators and banks. It will devastate ordinary families who trusted the system and played by the rules. The rhyme is clear and the ending is written. The only question is timing. When the crash comes, and it's coming, everything you think you know about building wealth will be turned upside down. But history provides a clear roadmap for those smart enough to read it. In every major financial collapse, from 1929 to 2008, the same pattern emerges. Those holding real assets survive and thrive, while those holding paper promises get destroyed. The key is understanding the difference. Your house is not a real asset. It's a liability disguised as an investment. Real assets are things that produce income, store value, and maintain purchasing power regardless of what happens to paper money. Real assets are farmland, not suburban houses. Energy infrastructure, not vacation rentals. Productive businesses, not appreciation speculation. Let's examine who survived and who didn't in history's greatest financial catastrophes. The Great Depression, 1929 to 1939. When the real estate bubble popped, speculators were wiped out overnight. Banks failed by the thousands. Homeowners lost everything to foreclosure. But certain groups not only survived, they thrived. The Mellons, Rockefellers, and other wealthy families actually increased their wealth during the Depression. How? They held productive assets that generated income regardless of asset prices. Oil wells kept producing, factories kept manufacturing, farms kept growing food, steel companies kept making steel. More importantly, they had cash when everyone else was leveraged. When desperate sellers flooded the market, they bought prime assets at fire sale prices. John D. Rockefeller Jr. was buying Manhattan real estate in 1932 for 10 cents on the dollar. The pattern was clear. Those who owned businesses that produced necessities prospered. Those who speculated on price appreciation got destroyed. The 1970s, inflation crisis. When inflation peaked at 18% in 1980, paper assets were obliterated. Stocks lost 70% of their real value. Bonds became worthless. Cash was melting away at nearly 20% per year. But certain assets soared. Gold increased 24-fold from 1970 to 1980. Farmland tripled. Oil and gas investments produced enormous returns. Real estate, the kind that generated rental income, provided both inflation protection and cash flow. The survivors understood that during inflation, you want to be a debtor holding real assets, not a creditor holding paper promises. If you owed money on productive farmland or energy infrastructure, inflation made your debt cheaper, while your assets became more valuable. The 2008 financial crisis. When the housing bubble collapsed, homeowners and speculators were devastated, but specific groups made fortunes. Warren Buffett was buying bank stocks when everyone else was selling. He understood that well-managed banks with strong balance sheets would survive and thrive once the system stabilized. John Paulson made $4 billion by shorting mortgage securities. He recognized that assets priced for perfection would crash when reality intervened. Private equity firms like Blackstone raised massive funds to buy distressed real estate at 30 to 50% discounts. They understood that productive real estate would recover, but they needed cash and patience to take advantage of the opportunity. The pattern repeated. Those with cash bought assets from those forced to sell. Those who understood the difference between speculation and investment prospered. Those who confused price appreciation with wealth creation got destroyed. The 2025 playbook, based on these historical patterns, here's how to position yourself for the coming housing crash. First, preserve purchasing power, not nominal wealth. Cash is king during deflation, but only if that cash maintains its purchasing power. With inflation still running above historical norms, holding dollars might be a losing strategy. Instead, consider assets that have historically maintained value during both inflation and deflation: precious metals, energy infrastructure, and productive land. Second, generate income, don't chase appreciation. The safest real estate investments are those that generate strong cash flows regardless of property values. A well-located rental property that cash flows positive at current rents will survive a price crash. A speculation play in Phoenix that requires 10% annual appreciation to break even will not. The same principle applies to all investments. Dividend-paying stocks in essential industries, utilities, consumer staples, healthcare, generate income regardless of stock prices. Growth stocks that trade on future promises become worthless when credit contracts. Third, avoid leverage in appreciating assets. Debt amplifies both gains and losses. When asset prices are rising, leverage creates wealth. When asset prices fall, leverage creates bankruptcy. The smartest money is reducing leverage now before forced selling begins. If you must use debt, use it only for productive assets that generate more income than the debt service costs. Borrowing to buy a rental property that cash flows positive makes sense. Borrowing to buy a primary residence that costs 40% of your income does not. Fourth, position for forced selling. Every crash creates extraordinary opportunities for those with cash and patience. When leveraged speculators are forced to sell, assets get priced below their intrinsic value. Start building cash reserves now, not just savings accounts. Consider money market funds, short-term treasuries, and other liquid investments that preserve capital and provide income. When the crash comes, you want to be buying while everyone else is selling. Fifth, focus on necessities, not luxuries. During financial crises, demand for luxury items collapses, while demand for necessities remains stable. Investments in food production, energy infrastructure, healthcare services, and essential housing will outperform investments in high-end retail, luxury real estate, and discretionary spending. This applies to your personal finances too. Reduce expenses on luxuries and increase investments in skills, health, and relationships that provide value, regardless of economic conditions. The geographic advantage. Not all locations will suffer equally during the crash. History shows that areas with diversified economies, reasonable cost structures, and strong fundamentals recover faster and fall less. The most vulnerable markets are those that experience the largest price increases: Austin, Boise, Phoenix, Nashville, and parts of Florida. These markets attracted speculative money based on migration trends that are already reversing as affordability deteriorates. The most resilient markets will be those with strong job growth in essential industries, reasonable price-to-income ratios, and limited speculative activity. Think Pittsburgh, Cincinnati, and parts of the industrial Midwest that never participated in the bubble. The timing question: nobody can predict exactly when the crash will begin, but the conditions are already in place. Rising mortgage rates have priced out buyers. Inventory is building in key markets. Institutional investors are pulling back. Credit standards are tightening. The smart money isn't trying to time the exact peak. It's positioning for the inevitable correction. That means taking profits on overvalued assets, building cash reserves, and identifying opportunities that will emerge when forced selling begins. The ultimate protection. But here's the most important lesson from history. The ultimate protection isn't any specific asset class or investment strategy. It's understanding how financial systems work, recognizing when those systems become unstable, and maintaining the flexibility to adapt when conditions change. Those who survive crashes aren't necessarily smarter than those who don't. They're simply more aware of how debt cycles work, how speculation differs from investment, and how to distinguish between real wealth and paper wealth. The housing crash of 2025 will be devastating for those who ignored the warning signs. But for those who heeded history's lessons, it will be the opportunity of a lifetime. The question isn't whether you'll survive the crash. The question is whether you'll be positioned to thrive because of it. The truth is both simple and terrifying. We've built an entire economy on the assumption that house prices will rise forever. From bank balance sheets to municipal budgets to retirement plans, everything depends on the permanent inflation of real estate values. But permanent inflation of anything is mathematically impossible. What we're witnessing isn't a healthy housing market. It's the final stage of a debt-fueled speculation bubble that has consumed everything in its path. The same forces that created this bubble are now reversing with mechanical precision. Interest rates are rising, speculation is retreating, reality is asserting itself. The question isn't whether the housing market will crash. The question isn't even when it will crash. The crash has already begun. We're just in the denial phase where everyone pretends that temporary pauses and minor corrections are signs of a soft landing. The real question is whether you'll be prepared for what comes next.